Do you want to invest in real estate but you don't know where to start? Then this video is definitely what you need to follow. Investing in real estate can be a lucrative way to build wealth and secure your financial future. However, not all the investment properties are equal, so it's important that you know how to analyze a property before making a purchase. In this video, I will cover all the key steps to analyze and invest in property and help you make an informed decision. So I summarized it here in a very easy way so you can follow what are all the steps. So you need to start first with the investment goals. So what do you want from this property? So are you looking for a long-term rental property, a short-term flip? Do you want a property that generates a steady income, so cash flow property, or a property that has more the potential for a significant appreciation and maybe not so much cash flow? So knowing these investment goals, it really help you to narrow down your search and focus on properties that align with your objectives. Assuming that you're looking for a long-term rental property, which is probably ideal if you want a passive income for your retirement, then you need to research the following steps. So research the local market. Once you have investment goals in mind, so you need to check the recent sales data, the rental rates, the vacancy rates in the area. So you can use a lot of online tools that are available in the US, like Zillow or Redfin in the UK, Zoopla or Rightmove, or Daft My Home in Ireland, where you can gather all this information and or even work with the more traditional way with a local real estate agent who has access to multiple listings. So why do you do that? Because you have to figure out definitely what is the best area you want to invest in, and it doesn't make sense to buy where the vacancy rates are really high, so it's not very likely that you find tenants, these kind of things, and all those tools that are helping you. I will make a specific video on that in the future. Now, next, analyze the property's financials. So now that you have a good understanding of your local market, it doesn't necessarily need to be where you live. Where you live, it might be a bad market for property investing. So don't be afraid of changing your location or even invest in another country. So now the property's financial. First, you need to calculate the property net operating income, so NOI, which is the income generated by the property minus its operating expenses. So like with that, you get a sense of the property's cash flow potential. Now, to do that, you have to do the review of your income statement. So the income statements provide an overview of the property's income and expenses. So includes the rental income, all the property taxes and other taxes, insurance, maintenance costs, service charge, whatever is cost. Then when you review the income statement, you get an idea of the cash flow and the potential for profitability. There's no point in investing if your cash flow is then non-existent or negative, unless you go for the capital appreciation. Now, next, you need to evaluate your rent roll. So the rent roll provides a detailed breakdown of the rental income for the property. Again, check if there are vacancies in the area. Try to figure out why the properties are vacant. Why is it because of the market conditions or issues with the property because the property is not a good condition? There's a lot of maybe the decoration is very old. So make sure that your property could be made in a very good order, so you can definitely get a very good rent, or the best rent you can get in the area, of course. Next, look at the cap rate. Cap rate or capitalization rate is a key metric used in real estate investing to evaluate the potential return of your investment. It's calculated by dividing the property's net operating income by the property's value. A higher cap rate indicates a high potential return on investment. Um, so again, these are all the metrics, very basics that you have to do. Um, Next, evaluate the debt service coverage ratio. So this metric is used to evaluate the property's ability to generate enough cash flow to cover the debt obligations. So the DSCR is calculated by dividing the property net income by its debt service. So if the value is 1 or higher, indicates the property generates enough income to cover its debt obligation. So I will make another video in the future where I go more deeply into all this, definitely all these ratios that you can use for making an informed decision. Then let's go to the next. Assess the property's condition. So of course it's important that you know what you're buying. It's not always that easy when you first look at the property to know what's the condition of the property, and even after you purchase the property, and unless you maybe strip it down, you might not have an idea of what are the issues with the property. But for that reason, first hire a professional, a home inspector or surveyor, which can definitely evaluate the property structure, the system components, and provide a detailed report or their findings. A very good way of figuring out yourself as well is to check basically what were the regulations at that time when the property was built. So it's likely that the properties will be kind of similar, unless there's specific issues with the property. But that's a very good idea to check that. And after a while, you'll be kind of familiar with that. Okay, is a property built in the 80s or in the 90s? And you know pretty much what that could be the potential issues, or anyway things that needs to be upgraded to be up to date with the current regulations. Now I mentioned the professional surveyor, of course. Then you need to also you can check it yourself again, but it depends on your experience. But surveyor might help you to figure out if there are some electrical, plumbing, or structural problems. Most likely the structural problems, and identifying necessary repair or replacement. So you need to definitely very quickly understand what's kind of a ballpark figure of how much is going to cost me to repair this and that, bring this maybe property up to date depending on their age. Making a mistake here, it could be very costly. It could be really ruin your investment. Then look for visible signs of wear and tear. Now there are some, of course, things that are not very important, like maybe a chair, a table, or things that can be replaced with little money. But there could be signs like maybe that are things that are more serious. So inspect the walls, the floors, ceilings. There could be cracks, water damage, mold. There could be an issue with the roof. Check the windows and doors for draft or signs of rot. And then could be also pest infestation. Check if there are droppings. That could be an indication that there are holes maybe and gaps. Very important step. Next, evaluate the property's age and maintenance history. That's easier said than done, but the age of the property and the maintenance history can really give you a good understanding. As I said before, if you buy in a properties that are 50, 70 years old, you know pretty much what could go wrong. Like the materials, everything has kind of a life. So if that property is that old, you'll have to redo the plumbing, you do the electrics, that kind of thing. You can definitely ask the seller or the real estate agent about the property's age as well, because it might not be that easy to figure that out. You can guess maybe, but better to ask. And look also if there's been maintenance done in the property. It could be that the property hasn't been touched, or will be or maybe it was rented, they didn't do proper maintenance, so all the, especially the radiators and others, if there's air conditioning or other things. um, Definitely, if the property has been neglected and poorly maintained, is definitely a sign of potential issues. Then, of course, you need to estimate the repair costs. Um, Now, currently, in my experience, because I followed a few renovations, um, it's very difficult now, because if you are used to repair costs, maybe pre-COVID, that's completely changed. Like, you have no idea. You could be actually spending 30-40% more just to do the exact same thing that you were doing before COVID. So yeah, don't assume that because if you have even experience on renovation like I do, don't assume that the cost will be similar. No, it's not going to be like that, unfortunately. Um, if you can, of course, if the market conditions allow you, try to negotiate a fair price if you see that the repair costs are higher than you expect. So work again, maybe with your surveyor or a contractor, to get an accurate estimate of the repair costs. You can try to use online tools as well, but might not be that reliable. Um, of course, now, another really important aspect is the location. So evaluate the property location. Why is that important? Because especially for rental, if your property doesn't have anything around, nobody would really be happy to live in the area. So first, look for properties that are in a desirable neighborhood with good schools, access to public transport, proximity to amenities like shopping and entertainment. So how do you research the neighborhood? First, look for information. There's a lot of statistics nowadays on crime rates, school district ratings, nearby amenities, any recent developments or changes in the area. Could be very simple, like a new park, or a new bus stop. Very simple things as well. Or of course, if there are infrastructure changes, like they're gonna put like a new train station or metro or whatever, then of course that's absolutely better. Now, you can use the online resources like neighborhood review websites, local news outlets, social media. That's getting very important now. You can definitely hear a lot about that. Um, or even what I used to do in the past, like just go and maybe in that stage, just ask around. Just people will be very helpful usually. Say, okay, like question like, do you like to live in this area? Is there an issue with this area? I'm considering buying a property here. I know if you live here, you have a lot of course, knowledge about the area. So can you please give me an advice, because I'm not from here, maybe. And that has worked really well for me to get a very quick picture, asking a few people in the estate, and I was very pleased with that. Of course, next, consider the proximity to work and transportation. Of course, if people can't go to work easily, that wouldn't be a very desirable location. Doesn't have to be, of course, because it might cost you too much. A property where there's a train station, a metro station close by, but a good and frequent bus service, it's already kind of a good thing. Now, this is a bit more tricky, so try to figure out where your potential tenants could go to work. Like, is there employment in the area? Yes or no? If there's no employment in the area, are the transport links bringing you to where most of the employment is in your city? That's a very good question to ask yourself. Yeah, try to then figure out, how easy is the commute. Like, let's say you're living in the suburbs, your property is in the suburbs, and you're trying to get to the city center where most of the employment is. how long is going to take you by public transport or driving, that kind of thing. Next, evaluate the surrounding properties. Take a look at the properties that are surrounding the property you are considering. So, are they well maintained and in good condition? Do you have similar features and amenities? The condition and value surrounding properties is absolutely important. If there's rubbish, there's no maintenance done, like the curb appeal is a disaster. There's no maintenance on maybe the windows, or the property hasn't been painted in 50 years. That doesn't really give a tenant a very good feel. So it could even be that in that particular part of the estate, everything is in good condition. Maybe another area nearby is not. So don't judge the area try to judge the specific property. Where is it in that particular road? Because the area might be different. The maintenance in the overall area. Then consider the local market. So the local real estate market also has a potential, because look at the trends in that market. So usually the trends are related to the desirability of the location, or even related to the employment opportunities in the city, the transport links, or whatever. So check the property's values, check all the information about the potential for appreciation, and whether the property is maybe overpriced, or because there are assumptions that are not really true. You want to get definitely into a property that can appreciate, because you can have maybe more value, or in the future things can improve. So don't maybe buy in a mature area where everything is perfect, because then there's not much potential, and there's a bit more difficult there. Evaluate the natural environment. This is very important, and I've seen a lot of issues with that. So weather patterns, check if there are natural disasters. I've seen a lot of properties that are maybe in a flood zone, and when there's something, it rains too much, then it's a disaster. And I know for a fact that when a property is flooded, it's just a disaster. Like you'll have to probably replace the walls, replaster everything. It's a massive expense, and sometimes the smell never goes away. So these are really important factors, and make sure you check if the property, if you have that kind of fear, can be insured, if the property has been insured before, because there might be issues with insurance, and that's in a real disaster then. Determine the property's accessibility. Now, is it easy to access? Is there a kind of a sidewalk, a bike lane? Is there parking restrictions, one-way streets? That kind of thing, also adds value to a property. And then to finish off, in conclusion, there are always risks investing in the real estate market. So market fluctuations, the tenant turnover, unexpected repairs. So be sure to consider these risks and have a plan in place to mitigate them. So have cash aside for that. Don't assume that the income that you're getting is going to be guaranteed, because there could be many potential issues. So I think by following these steps and working maybe with a knowledgeable real estate agent, you can make an informed decision and invest in a great rental property for your investment goals. Thanks for watching this video. If you like this content, please subscribe for more. Bye for now.